of funding is becoming more and more difficult. There is a funding winter going on, and the major reason for that is the economic upheavals which are there in few economies of the world, especially Europe, and to some extent, American economy is also going through a bad patch because of the bank crisis and other crisis going on. But that doesn't mean that the funding has stopped. The funding still goes on. The show goes on, and so is the new startups which are getting registered in Startup India. As of I saw it last week. We have now 97,000 registered startups in India, which is a huge number. 97,000 in and this number has grown tremendously recently, and the growth pattern in the startup world and the number of unicorns also are going up. India is seeing a lot of success in the particular startup ecosystem, and so whatever we may say, the startup funding may have dried down a little bit from international perspective, but still there are many investors who are looking at India and Indian market very positively. They are actually investing big time in India, and I know of certain funds who are very, very aggressive in the Indian market, and they are having their bigger plans for India and Indian startup ecosystem, and particularly the startups which are into the space where the funds are, very, very. So that is, the scenario where we see. Rishabh, can you just put yourself on mute? So, that's the particular scenario which we have to discuss today. We all know that year 2022 was one of the ones which saw unexpected changes, and but there are several learnings for the startup, venture capitalists, founders, and others. So it is not only a tough period for the startup ecosystem, but also for the venture funds who are looking for putting their money in excellent startups. And of course, the founders are also having a little tough time in presenting to the various investor groups. And, as per the recent report, Indian startups have raised almost 24 billion in year 22. And although this is 33% less than the number which was there, which was almost 33 billion in year 2020. And, but it is much more than the numbers which were there in earlier years. No? So there are two sectors which have remained unperturbed. One is the software as a service and fintech. So fintech has also, as we know, that there are many companies like Paytm, PhonePe, and many others who have really done well. And Paytm raised even IPO, although the IPO was not after the IPO, the price has come down, but still there are a lot of good developments which are happening in these companies, which will definitely make sure that they stabilize. And the startup ecosystem is going to be third largest in the world, and it is expected that it will contribute almost 10% of the GDP of India, and it will be a backbone for the Indian economy. So let us look at what are the funding options. I think that's the most important part for us to look at. The funding options, we all know, one, equity share capital, which is a very straight, plain, vanilla funding option, which we all look at. And then there are compulsory convertible preference shares, which is the shares which are converted into equity at a later date. And the date at which, or the event at which this conversion has to take place can be decided. And, the CCPS, as we call it, is a very, very popular instrument now these days, and a lot of people they opt for CCPS. The other way is compulsory convertible debentures, which is CCD. Now, the debentures are issued, which are issued in the form of a debt to begin with, and then later on they are converted into either equity or preference shares, depending on what kind of issue you are bringing in. And this is again, something which we all know that in vogue, because there are many people who don't want to put their money at risk in the beginning itself. So they are very comfortable with this instrument because it comes in as a compulsory convertible debenture. So the money which is offered remains secured till the time it is converted into equity. And in the initial stages itself, there is a risk. Once the startup has done 2 years or 3 years of run, there is a possibility that this startup will always show good results, and you are very sure that what is the future of this startup. And the conversion into equity at that stage is much more safe if we think from investors' point of view. Then, of course, there are shareholder loans, other debentures, redeemable or optionally convertible debentures. And so this is again something which gives a fillip to the fundraise, because funding is something which is definitely has its own challenges, and how this funding has to be done is basically a challenge for the startup ecosystem. So the other form of funding is, of course, the preference shares, other preference shares, whether redeemable or optionally convertible. These are not compulsory convertible preference shares, not CCPS, but the other preference shares. And there can be a mix of above. So there can be a equity plus CCPS, there can be equity plus CCD, and there can be a loan cum debenture option, or only preference share option. So these are the various ways through which the equity raise can happen. And this is where I think the overall preference of the it all depends on the project, what is your size, and also what kind of investors you are getting who are willing to look at your offerings, and who are willing to take how much risk they are willing to take. So idea is to get the funds when you are in this beginning stage of your startup. It is very important that there should be a good flow of money coming in. So so funding is an important aspect. and you have to make your investor comfortable that okay, if you are more keen on CCPS, we can do that, and if you are looking for CCDs, company can also plan that. And so it all depends on the consultant or a merchant banker who's supporting the startup to get into this, um, uh, and also how they actually you know uh, make this happen for the company. So key drivers for choice of funding, of course, exchange control regulations and regulatory requirements are there. So you need to look at that, and you need to comply with those requirements which are there for the startups. And also the Indian company law regulations. So money fundraising, of course, is monitored by the Companies Act and the company regulations. So this is also something we need to be cautious of, and so we need to be aware of these company law regulations. Then tax efficiency, as to how these activities are tax efficient. Sometime we even invited a gentleman from one from Singapore. So he always talks about that there is a benefit of registering a company in Singapore. Now, one of the big benefit is that you don't have to pay capital gain tax, and that is the capital gain tax which is paid by your investor when they sell their equity. So the equity investment in a Singapore-based company becomes all the more attractive for the investor, because when they sell that equity, they don't have to pay the capital gain tax. So all these tax efficiencies and tax management tools are adopted by the various companies, and this is where we as a advisor to them come in. So ease of repatriation is another very big area, and of course other commercial considerations, like voting rights and control, etc., are the other areas which actually help the startups to move forward and have this working for them. So this is something which I think so the picture is very clear that there are various options for raising funds, and there are various tools for raising funds. There is no dearth of funds available in the market. How we carry ourselves, how we actually execute our plans, how we raise money, it all depends on us, and we need to actually plan well. And that will lead to various actions which we can take to enhance our to meet our funding requirement. So let's look at we always talk about equity, but what is equity? I think we all understand it's company's worth. It is the value of equity stake in a business. So so there are various type of equity funds. There are large cap funds. Then there are mid cap funds. There are hybrid large and mid cap funds. So this we are talking about the equity funds which are operating in the market. There are certain small cap funds also, and there are multi-cap funds. So equity space is also having various funding companies, which you need to understand what is their market capitalization ratio, and what kind of funding they are looking at, and accordingly you need to approach them. If you just try and approach each and everyone left, right, and center, you may have challenges of rejection, and you may have challenges of they not responding to you. So sometimes you get disheartened because you have approached so many people, but they have not actually, reverted to you. So I think that we need to be very careful about. There are different set of people who are investing in seed rounds. There are different set of people who are angel investors, and there are different set of people who are actually, putting their money in the equity at a later stage when the company is mature enough. Their POC is also there, and they have already executed a few things. So equity formula, we all know, is assets minus liabilities. That is where I think the deciding factor comes in. So, if your credit worthiness is an issue, you need to look at better options. Then, if you are more of an independent solo operator, you can start with a loan, and and you don't have to share the decision making and control of the company. If you would rather share ownership or equity than have to repay a bank loan, because it is always better to have less of interest burden in the initial stage. If you get a good equity partner, it is always better that you kind of take it forward with your equity partners. If you are comfortable sharing decision making with the equity partner, that is another very important deciding factor for you to choose which option is better for you. And if you are confident that the business will generate a healthy profit, you might opt for a loan rather than have to share profits. Because if the profit margins are so huge and very good, then you might take a loan and then repay the loan once the money comes in or money flows into the system, and you make money out of your initial investments. And that's the kind of deciding factor for your adopting what routes you have to adopt for raising your funds. CCPS, we all know, they are corporate fixed income securities where investors can choose to turn into certain number of shares or company's common stock after a predetermined time span or on a specific date. So in CCPS, we have a predetermined time span, and there is also convertibility which is there on a particular date. So you can say, okay, this conversion will happen, say, after 3 years or after 2 years, or will happen once I'm going to launch my commercial production, or it will happen once we will move into the phase 2 of our project. So these can be some predetermined goals at which stage this conversion has to take place. And kindly, Nishant, can you put yourself on mute? Okay, so this will happen if you are basically having a predetermined time span. And also there are class of shares which are compulsorily convertible into equity shares, and the convertible portion can be full or in part. So this is how the CCPS move, and also there are sometimes discounts attached with the CCPS. So, for example, you are issuing an equity share which is convertible at say Series A. Now at Series A timing, your valuation is, for example, maybe 10x of what you are offering today. So to the CCPS holder, this can be offered at a discount. So you can say, I'll offer you at that time, whatever is my valuation pricing, I will offer you 30% discount. So instead of being 10x, you can offer it at say 7 timings the price. So that's how the CCPS investors tend to gain, because they are early movers. They are taking risk on you in the early stage. So they will be, they should be given actually the benefit of convertibility at a stage where this compulsory convertible preference shares will be issued. So what does it do? Give investor and founder maneuverable rights on share as the company scales. And as startup go fast, CCPS helps change terms from time to time and protect the investors' interest. So investors are better placed when we are offering CCPS, and they have a better leverage over their money. And in case the startup fails, they get a preference, so they will be settled first. So that is again a very important aspect. So there is a risk mitigation as far as the investor is concerned, because they get their money back at a faster pace and before the settlement of the equity players. So this is again a very, very important aspect of CCPS. And who use it? Internet startups, private equity backed firms, fast growing companies, they are all using CCPS. So why do investors prefer CCPS? One, of course, the growth stage of the startup. Normally we get into a CCPS mode where the investors have the leverage of convertibility. It is also crucial not only to the startup founder, but also for the investors to find the best way to become part of the company, so that they not only benefit out of it, but also safeguard their interest. And they offer profit potential for stocks at lower risk to the investors. So there is a huge risk mitigation as compared to the equity holders. So that is why CCPS is increasingly becoming a very attractive instrument. And a lot of people, they are actually talking about CCPS. There are a lot of CCPS issues which are coming, and that offers a lot of support and strength to the companies which are looking for funds. And so it's a win-win situation for both the company and the investor, because the investor gets assurance that okay, their money is relatively more safer, and they also get the preference, and as I said, discounts can be made available to them once the a particular event comes. So or at a Series A level or B level, these guys who are holding CCPS, they can be offered some discounting percentage of the equity valuation, which is a very, very plus point. So how these are different? So basic distinctions, I think we have discussed it earlier also, but I just want to make you understand it once again. Voting rights because in preference shares, the holder of these shares do not enjoy any voting right except for their class meeting. But in equity, the equity shareholders enjoy the voting rights. Payment of dividend, the holder of these rights have a preference right as to the payment of dividend, whereas equity shareholder get a dividend after the payment of preference shareholders. So when it comes to the dividend payments, the preference shareholders have got the better option. They will get the dividend first, and only then the equity shareholders will get the dividend. In case of repayment of capital, a holder of these preference shares will get the repayment of reference capital first. So that is the advantage of having a preference share capital, because they get a preference in at the time of settlement in case of unfortunate situation that the company is being wound up, or the capital is being repaid. So the preference goes to the preference shares, and the payment of equity share capital is made after making payment to the preference shareholders. The rate of dividend is fixed, whereas the rate of dividend may vary. So again, in the case of preference shares, it's okay, 5%, 10%, 6%, 7%, whatever. So that is a fixed preference share capital. So they get the dividend as a fixed percentage. Whereas in case of equity share, it depends on the company. If there is a profit, then they may get 20% also. But if there's no profit, they may get 0% also. So that's the kind of scenario which exists. And of course, preference shares can be converted into equity, but equity shares are non-convertible. That's another very important distinction. And the preference shares are redeemable during the lifetime, and whereas the equity shares are not redeemable during the lifetime of the company. So that's the another important distinction between the two. That is about the redemption part. And so advantages in case of equity, there's a less burden. When equity financing is there, there is no loan to repay. So this is from the startup point of view, and the business doesn't have to make a monthly loan payment, which can be particularly important for the business. Doesn't have profits in the initial phase, and this in turn gives a freedom to channelize more money into your growing business. And also the credit issues gone. If you lack credit worthiness and you have a poor credit history, or you have lack of financial track record, equity can be more preferable and more suitable option than debt financing, because you may not get debt if you don't have collateral security to offer, or if you don't have the track record to show. And learn and gain from partners. With equity financing, you might form informal partnerships with more knowledgeable and experienced individuals. Some might be well connected, allowing your business to potentially benefit from their knowledge and their business network. Whereas there can be a different situation otherwise. In case of CCPS, the owners of preference share receive fixed dividend well before the common shareholders. That's the advantage, as we discussed. Higher claim on company assets, because in case the company experiences bankruptcy or there is a subsequent liquidation, preference shareholders have a higher claim on company's assets than the common shareholders. And of course, the preference share attract conservative investors. And also there are additional benefits, because convertible share lets investors trade in these type of preference shares for a fixed number of common shares, which can be lucrative because when the common shares become more valuable and they are climbing, at that time, the investors stand to gain, and this participation let investor reap additional dividend, and also which is above the fixed rate. So in all, CCPS is very attractive from the investor standpoint, and it gives a comfort to the investors because they tend to gain when they actually put their money. So what are the disadvantages? Now let's look at it. In case of equity, you are sharing your profit. Your investor will expect and deserve a piece of your profit. However, it could be worthwhile trade-off if you benefit from the value, because they are the financial backers of the company, and their business acumen and experience can come in handy. But you have to fully share your profits. Loss of control, because you have to pay the price for equity financing. To all the potential advantages is that you need to share your control of your company. All the decisions have to be taken, taking all the equity shareholders in confidence. So when you are actually running your organization, it is important that if you are having equity shareholders, you need to create a consensus, and you have to take them along with. There are potential conflicts, when you are sharing ownership and having to work with others, it could lead to some tension or even conflict. And there are differences in vision, management style, way of running the business, and it can be issues. There can be issues which need to be considered carefully. In case of CCPS, the disadvantages are there are no voting rights. So the investor who don't enjoy the same voting rights as the common shareholders, this means that the company is not beholden to preferred shareholders, and as compared to that of equity shareholders, as we just discussed. Equity shareholders have more powers to participate in the business. They have better control over the company. Whereas in case of CCPS, the controls are lesser, but the money is more safe. They can get it, they can convert it in a better way. And also the fixed dividend, because although guaranteed returns on investment make up, but if the interest rate rise, the fixed dividend, when sometimes the interest rates become much more better, so you may have a disadvantage of fixed dividend. That can be so sometimes advantages become disadvantage also. So that's what is the case in point here, and it could cause buyers a remorse that preferential shareholders, investors who may realize that they have fared better and higher interest fixed income securities are available, but still they are putting their money. But I think that's not that important, because at the if you compare them with the equity shareholders may not get the they may not get at all the investment, the fixed returns, but the others may get fixed returns, and that's what is the most important aspect. Now, if we look at just a minute. Okay. So this is what are the advantages and disadvantages of the various instruments we have talked about. I take a pause here and would welcome any questions from your side, so that we can discuss and then move forward with my presentation. Any questions, please?
Yeah. Yes, Rajivji. The CCPS is like initially they will pay us interest, then after that it will get converted into equity. Am I correct?
So it is cumulative convertible preference shares. No? So when you are issuing CCPS, so there can be a fixed interest rate which is being offered, a preference dividend rather. It is not interest actually, and so CCPS is it can be converted at a particular stage. So you can issue 2-year CCPS, or you can say at the launch of the commercial production, when the Series A will happen, at that time this conversion will happen. So it can be linked with an event, or it can be linked with a particular period of time. And of course, there is a kind of a preference dividend given to the CCPS holders. And also,
sorry.
please. And
Please.
one more thing I wanted to add, that, and also there is a discount which is offered to these CCPS holders at the time of Series A, Series B issuance. So you can say that 30% discount coupon will be given to you. So at that time, suppose Series A is happening at 100 rupees. So CCPS holders will get the same share at 70 rupees because they got 30% discount coupon. Yeah.
Rajiv, in case of CCPS, it's a fixed dividend only, right?
Yes.
So that means if it's the difference between debt and CCPS is debt, we have to service it at the fixed rate, irrespective of what happens to the company. But in CCPS, it is based on dividend. I mean to say, in case tomorrow we don't declare any dividend for the 2-3 years, nothing will be paid to CCPS.
No. They are the preference shares with fixed dividend. No, so they will get the dividend. You promise them dividend, so that is why.
No, we promise them dividend if we declare a dividend. If we don't declare, the company is not in a position to declare a dividend. Then will they get any money?
CCPS is normally, you say that I'm going to give you 5% or 6% return, irrespective whether I make money or not.
Then how is it different from debt?
No, so this is a very refined form of debt. So it is better than debt because you are giving them a option to convert into equity also at a later stage. In debt, there is no option to convert to equity because debt instruments.
So
debt instruments are very straight. Yes.
Okay, got it. So it is a discounted debt.
Mr. Rajiv, can I add something?
Yeah, please.
You see, in the practice, I have seen the rate of dividend is very low. Even I have seen the rate of dividend at 0.01% also.
Yes. CCPS, people are, because all these investors, they are not looking at the dividend only, right? They are more concerned with the preference of getting the money back in case the company becomes insolvent. No. So that is why 0.01% CCPS also sells. The main advantage to the investor is that in case the company goes bankrupt or the company has a financial issue, they will be settled first. No, so they have a preference over the normal equity shareholders. That's the biggest advantage.
Even prior to preference shareholders?
They are the preference shareholders, no? Cumulative convertible preference shareholders. So
in case we have some preference shareholders also existing.
So only difference between them and those preference shareholders is that they are not having convertibility clause. So they will rank equal to the other.
Equal to the preference shareholders.
Okay. Yes. Any other questions, please?
And CCD is it's like a debt loan.
Yes, it is like a loan. It is like a debt. and the debt, like you have to repay the debt. In case of insolvency, debt holders will have a better preference as compared to the others. No, so debt is where it's basically a state loan, and CCDs are issued where normally the rate of interest is also fixed. So, but there is no convertibility into equity shares. So they are very clear that there is no conversion which is going to happen, and there is hardly any convertibility which will be there in case of CCPS. Sorry, CCD.
Could you just give some examples currently in the market for CCPS and CCD currently?
Many Ajish, I don't know which issues are going on as of now, but there are many companies where CCPS is being issued, because these are very closely managed, because only fund managers will be knowing to which company CCPS is getting issued. But for example, there are, as Kailashi was mentioning, he saw one of his customer. So I don't want to name the companies because that will be unfair. But there are many companies which are, but these are all private limited and closely held companies, so which go to the market. So the fund managers, they decide whether it is better to opt for the CCPS or state equity. But let me tell you, the fund managers are becoming more and more keen on CCPS rather than state equity, because it gives them more leverage and it gives them more options for converting and safeguarding their money.
And what is ease of repatriation?
Repatriation is, ease of repatriation means you can take the money out of the country, because, if the money is repatriable, then you can take it out of the system. No, so all these foreign funds, they are very. This is a very important factor for them, that they should be able to take the money back to their country. So that is the ease of repatriation.
Thank you.
Okay. So,
sir, one more question,
yeah,
sir, here.
Sure.
What is the ESOP transfer of equity?
ESOP is basically offered to the employees of the company. Normally, this is a tool which is being used for retaining good employees by the management. So ESOP is, employee stock option scheme, where the employees are told that, okay, we will offer you, say 1% of the equity or 0.5% of the equity, or there are certain shares which we will issue you, and you can sell those shares at a later stage at the price at which they will be valued. So ESOP is a different ball game altogether. So it's not exactly same as a equity, but it's a equity, but given to the employees as a kind of a supporting them or making them stick to the company, and it is normally linked with, okay, we'll give you ESOPs after completing 4 years or 5 years of service, or like that. Yeah. Yes, please. Yes, Vijay.
So one other question, sir. Sir, one other question. Suppose if I will transfer, right, 80 or 90% of ESOP equity to one particular person, then means that person will be the owner of the company, or how to say?
No, normally ESOPs are, maximum ESOPs are 5% of the overall company. No? So, it depends what percentage of ESOP is being offered. Now, the company, you are saying 90% of the shares are offered in ESOP. That doesn't, ESOPs are normally not more than 5% or maximum 10% of the total capital of the company. So I don't think that leads to transfer of ownership. Yes, there is a sense of ownership because I am also not only employee, but I am a shareholder of the company also. That's the purpose of ESOPs.
Okay, sir. Thank you.
Yeah. Kindly put yourself on mute, please. Yeah, Bishwajit,
Yeah. Thanks for all the info. I have a question a little bit out of line of what we're discussing right now. Just I wanted you to recommend, because since you are so expert in this startup ecosystem, could you please recommend us some of the crowdfunding platforms great for angel investors?
Yeah, I'm aware of a few of them. So I would not like to mention their names here without getting any sponsorship fee. But I'll talk to you separately and definitely connect you with few of them. There are few great platforms who are getting good traction, and there are few platforms where the funding option is as low as 5,000 rupees for the investors. So what they are doing is they are actually making startup investment very easy for people, and they are actually encouraging smaller investors also to come into this space. So there are some good crowdfunding platforms. So I'll definitely recommend you a few.
Great. I'll be in touch with you separately. Thanks.
Yeah, sure. Any other question?
Hello, sir. So through CCPS, investors get a dividend income. Secondly, they get preference if the company liquidates. Thirdly, if the company grows and it's beneficial for equity holders, they can also convert their preference shares into equity shares.
Yes, it is compulsory convertible, so it will get converted at a later stage. Yes.
Okay, sir, what are the advantages, disadvantages for founders for if they choose to take CCPS funding?
See, founder, it is the same situation. One advantage for the founder is that you don't have to lose your controls in the initial stage, because when you are offering equity, you are passing the voting rights also to the shareholders, right? In case of CCPS, they are preference shareholders, so they don't get the voting rights immediately, although they will get maybe after 2 years or when the conversion will take place. So this is one advantage for the founder. Second advantage for the founder is that, okay, you are giving comfort to these people that your money is more safer with us. So it gives, because in the initial stages of your you don't have anything to prove, you don't have anything to talk about. But when you issue CCPS, you are actually reducing their risk, because suppose there is a uncomfortable situation where the company goes into liquidation or insolvency. In that case, you are paying this money back to these CCPS holders. So it gives them more comfort. So founders get better, money or quick money or easy money easily from these people without having interference as an equity shareholder. So they have that voting power still with them till the time this conversion happens. Okay.
Thank you, sir.
Yeah. All right. Now, current scenario, we would like to sum up our today's discussion. We have talked about there are various funding options. Venture capital funding, of course, there are firms which are major source of funding for startup. These firms invest in early stage and high growth companies with a potential and significant returns. And this varies from region and industry. And some VC funds are particularly tech startup funding VC funds. Some are deep tech. Some are in EV space. Some are sector agnostic. Some have funding rule that okay, they are only funding startups which are having 3 years of track record. So it all depends what kind of fund. So when you are approaching a fund, look at their funding decisions, how they are going to look at your organization, and then opt for those VC funds which are actually good for you, and also check whether they are into seed funding and angel funding or not. So angel investors, we all know, they are individuals who provide capital to startup in exchange of equity ownership. They invest in early stage of the company's development when the risk is high, but the potential for growth is substantial. So angel investor can provide not only funding, but also mentorship and industry connections. So you should always look for angel funding, and they can be helpful to you in both the ways. And crowdfunding, of course, the crowdfunding platforms have gained popularity because they are an alternative means of funding startups. So entrepreneurs can present their business ideas or prototypes to the public to raise funds from individuals who are interested in supporting the project. Crowdfunding allows startups to assess a wide pool of potential investors and who are willing to do quality investment. So, and as Biswajit mentioned, this is something in vogue these days, and there are many crowdfunding platforms. I know a couple of them, and so if you need any specific help, please get in touch with me. I'll definitely guide you and how to connect with these crowdfunding platforms. There are corporate investments also, which are there as a startup funding. Large corporations are increasingly getting involved in startup funding by establishing their own venture capital arms or innovation funds. So these corporate investors seek strategic partnerships and opportunities to gain access to new technologies, markets, and talent. And then, of course, government grants and programs. Government has, grants, loans, and tax incentives for innovation and entrepreneurship. A grant of 20 lakh rupees is given through various Atal Innovation Missions, and a lot of innovators, they are encouraged to fund the startup ecosystem. So all these innovation centers, they are, they can actually get involved with these startups, and they have a program to aim and stimulate growth, job creation, technological advancement by supporting startup and small businesses. So this is how this whole thing works. We had a program on government grants also earlier, where we discussed what kind of grants are available. Amazing grants are there. So if you need more information on grants, please you can get in touch with me. I can help you with that part. So what is the role of startups in economic growth? Of course, production of jobs, distribution of wealth and creation of wealth, improved standard of living, growth in GDP, promotion of exports, and of course, overall economic development. So the employment, local employment in particular, is being created by all these startups. Of course, they also begin to purchase goods and services, and a lot of cash revenue and other things flow, which actually boost the economy. And also they create innovative solution, and technological advancement happens, which improves the quality of life of people. And of course, they maintain the requisite level of enhancement. So these are the top 20 startups of 2022. I just thought, let me share these examples with you to motivate you that all is there to look at. Cred was at the number 1, Upgrad, we all know, Grow, Zapto. Zapto is a revolution of the last year because delivery in 10 minutes, nobody thought it's going to be so exciting. Skyroot, there is a MBA Chaiwala, Spinny, the car, second-hand car selling company, the Good Glam Group, which is into the cosmetic space, Growth School, which is into teaching education on digital marketing, Blue Smart, we all know, in Delhi NCR and Bangalore also they have started operation. The electric car company, which is offering rides at a cheaper price than Ola and Uber. ShareChat, Tito Insurance, Simple, Rapido. Rapido is also something, first time I saw this in Southeast Asia, and that was around 14-15 years back, but now this ride facility has come in India as well. Class Plus is a EdTech company. Park Smart, they are taking all the parking lots by storm. They have almost got big space in all the big, housing complexes also, and apart from malls and other places. This club, Dealshare, Ultra Human, Living Food. So they are huge, examples of companies which have really done well. So this is kind of a motivator for all of us to try our best to work and expand ourselves in startup space, and be very active, so that you never know where to. So if you are early investor in any of these startups, it can lead to a lot of value enhancement, and it can lead to a lot of space to you. So thank you so much. Any other question you have, I'll be very happy to answer. Any questions, please?
Rajivji, just one little question. Sanjay here.
Yeah, Sanjay.
This crowdfunding, when people just mentioned anything interesting was 5,000 rupees and things. So are they also equity shareholders also? They become,
yes,
they get the
yes. Normally crowdfunding is in the shape of either CCPS or equity.
Okay.
So normally this is the model. But yes, the equity size is so low, maybe less than 1% or something like that. So when you give equity to big players, so somebody is holding 15% or 20% of your company, they can ask you more question and arm twist you. But this kind of a thing may not be that they may not ask so many questions. So that's the difference.
It's like an IPO.
Yeah, it's a mini IPO.
Mini IPO. Okay.
Yes.
Before hitting the IPO, it was like a pre-IPO. Okay.
Yes.
Got it.
Yes.
Got it. Thanks.
Okay, thank you very much, and thanks for joining in, and do spread the message around so that more and more people can get benefited from our deliberations, and thanks for